Hey everyone, so today I'm going to break your limiting beliefs on options trading. I've heard so many questions and so many people are reaching out to me and saying, I don't have a big enough account. I think options are really risky. They're only for pros or professionals. Um, I don't understand the complexity of it. So I thought I'll make this video and I'll show you exactly what we do and how we do it step by step, and how to make consistent income. And then I will also take you to my real trading account. Well, actually, everything is on the real trading account. And I'll show you my two positions that I currently have. Those are not doing really well because of the whole tariff situation. I added them as soon as the tariff news broke out. And since then, I've been managing them and, basically trying to reduce my risk in those positions. But I'll show you exactly how it works. Prior to the March or April tariff news, everything was going fine. Obviously, there wasn't much volatility in the market, so things were really moving smoothly. However, this is the best time to sell options, and what we do is that we sell options. And I'll take you through this presentation, and in the end, I'll drop a link in my description where you can download the whole the whole deck, the slides that I'm going through right now. So let's go through it and then see why do we do what we do actually. We sell options. We don't buy options, and there's a reason why we sell options, and that is because we believe around 50 to 60% options expired worthless. Now you must have seen this number go up to like even 90%, 80%. I don't believe in those because I read a report from CBOE, which is the options exchange, and then they say that the number is close to 50 to 60%, maybe even slightly less. But anyway, this is where we pin it down and say between 50 and 60% of options are worthless. So why should we buy them? Out of the money options or whatever options. Now we sell these to people who want to buy it, and we sit and wait on them, and we collect data, we collect time decay, we collect some premium, and then we collect, we try to make about 30 to 35% on each trade after commissions. Now, the way we trade at skilled and long short ideas is we take into account all the commissions that are out there. Currently, we are trading all the futures options. We think that it's the best capital efficient vehicle out there. Meaning, if you want to try, if you want to trade stocks directly, it will cost you a lot more to make the same amount of money that you can make with one third of the capital that is invested on the stock or the ETF side. So that's the power of futures options. Now, let's go to the next slide. 3 rules of option selling. I want you to list them down, print this slide, and put it on your computer or wherever you trade. Just put it in front of you. We trade high IV stocks or high IV underlines. I shouldn't say stock because we trade futures. We trade futures options. We trade stocks, ETFs, you name it. We trade everything. Commodities, metals, gold, silver, everything. Now, we sell premium when the IV is high. What is high IV? Basically, when it's above 30 to 35% or 40%. That's the IV number. That's where we draw the line in the sand. We say if the IV is high, we sell more. If the IV is low, we sell less. We still are active in the market, but we do not have that many positions on. We are not as invested as we are when IV is high. So these are the things that we look at, and we only look at liquid underlines. And I will take you to the platform and show you exactly what I mean by liquid underlines, like what is it that we look at, meaning the bid-ask spread, how the underlying is trading, all that kind of stuff. The third and the most important one is like the strategy fit and how do you manage a losing trade? Because here's an option. With an option, you always have an option to adjust and manage and risk manage the position. Meaning, if it's going against you, there are things that you can do to control the risk, to reduce the risk, and then stay in the game. The whole point here is like to stay in the game, so that you have enough trials and errors in this process and method that eventually, when you have enough occurrences here, you will start seeing some P&L in your account. Problem with buying options is it gives you a quick win, and then you put the money in again, and then it takes away all the gains, and then you're done. Your account is flat. Here, because there are ways to manage trades, you can stay in the game longer, and you can play this game longer. You can have more trial and error, meaning you can have more trades. The more you trade, the better you become, and the smaller you trade, the bigger your account becomes in the long run. Please keep that in mind. That's what I live with. We trade small positions. We don't, and I've underlined that those two letters as well. We don't trade big positions because we try to diversify our portfolio, meaning we invest capital in different underlyings, different positions, different strikes, different expiration cycles, all that kind of stuff. Next, so I want to take you through first theoretically what we do and what we look at. This is a platform screen clip. This is how my platform is set up, and I will take you through there. And if you want to look at it, it's actually in the dark mode right now, but this is how it is. That's exactly how it is. But when I was taking the screenshots, I changed it to the light mode. Anyway, that's not important. Here, this is the ES option chain. If I go to the 50, is it ES? No, it's not. It's the crude oil market. I need to change this to ES. I just want to show you where I got that screenshot from. So there you go. And if I go into, and just remember, I have some live positions on in this 52-day cycle. Like I said, I did not start in 52 days. I started in 40 to 45 days when 3 weeks ago or 2 weeks ago. And since then, I've been managing and trying to reduce my risk. And I have recovered a lot, half of the losses so far. But right now, the marketing right in the middle for me. Well, not really in the middle, but somewhere around there. Somewhere around there. So there are some losses here. Maybe I think I'm out by like $500 overall. I can check the P&L year to date on this. Go here. P&L year to date is positive. No, but this is not correct because the overall P&L is negative in this position. And this is my other position, which is the 6E, the euro currency. That one's hurting a little bit, but after some adjustments, I am managing it, and hopefully in the next few cycles, it will take me some cycles to like recover everything there. But here, I'm sitting right nicely in the middle. Just need the market to like not go too far out for me, either on the upside or the downside. But anyway, okay, let's come back to here. So this is how I look at the expiration cycles or the screen when I want to trade. Now, I think I took a screenshot a couple of days ago. So that's when SPY was trading at 546. I have delta, theta, open interest, and volume numbers on. And this is the implied volatility column that I look at. So, and this number here, 57 days, you can see here. When I clicked it, it went to the next slide. Anyway, this 57 number here is the number of days left in the cycle. So if I would have traded this, I would have traded this in this cycle because there wasn't any other cycle available. Maybe there was, but it wasn't really interesting to me to trade less than 57. Let's see if I have to like trade SPY right now. What are the cycles available? Why did I take a 57? Because 57 days still a little bit further out for me, and I would have normally traded a 45-day cycle. So let's bring up SPY. Okay, yeah. So the monthly cycle was only 57 days when I was taking a screenshot, which was 5 days ago. Now that same cycle is at 52 days. So that's the reason why. And the way you can tell that is because these monthly cycles are like they expire on the third Friday of the month, and they are in gray. They're in gray color. The other weeklies and dailies and zero DTEs are in yellow. So that's how you can differentiate them. Okay, so here's what I had. This is what I have looked at if I was trading this ticker on that day. I would have gone on the 18 to 17 delta strike on both sides, meaning I'm selling a strangle here. Let's say, for example, good open interest and high volume numbers here. You can look at this here. With a click, it keeps taking me away, but I can just use this pen. So this is the number one thing we look at. Open interest, look at all these numbers. And then volume, again, a number one thing. And just for comparison, I want to show you like how the weekly numbers. Now look how these guys are in thousands, right? 20,000, 67,000, all that kind of stuff. Next one is a weekly cycle. Let's pick up this 30-day cycle. Look at the open interest and volume numbers here. Hundreds, not even hundreds, tenths. So we don't touch these. There's not enough liquidity here. These guys trade really wide. Not many people are trading these. So we stick to these open interest and volume cycles, like the monthly ones. This is where most of the interest is. Anyway, I would have gone on the 17 delta strike on the call side here, and then because 17 is not available, I would have gone to 18, one strike above. So if it's not available, you go one size above, not below. Below is 16. Now then, at 16 you don't get enough credit. I just don't like to trade one below. I would rather trade one above. If 18 wasn't there, I would have traded 19 delta. Okay, so this is the at the money strike. This is how I would have looked at. I showed you the delta column and I showed you the theta column. The other important part is the implied volatility column. Now this is high relative to its 1 year ago implied volatility in the same cycle. The expected move. This is the expected move in the column in the bracket, meaning the ticker is expected. SPY is expected to move $45 between now and the end of the cycle, meaning in the next 57 days. When I took this screenshot, this ticker is expected to move $45 up or down. You see how it's like plus and minus? Plus and minus means it's either going to go up 45 or down 45, right? And if 45 here means, let's say 590. And its overall all-time high was 611. If I'm not mistaken, SPY's overall all-time high has been $611. Let's take a look at the chart. It's coming up. So expected in this 52-day cycle, looks like 613 actually. So okay. So, and I want to show you one more thing. So anyway, so that's how we look at the expected move. Let's go to next. Next, really important. How much capital should you invest or put down in each trade? Now, each trade should not be more than, this is the sweet spot. I don't want to pin a number down here because some people have small accounts. Like I have a $5,000 account. This is my sweet spot. I trade between 350. This is my usual spot, 350 to 250, 5 to 7%. But that's because I have a small account, right? Now, if you have a bigger account, let's say $25,000, you should be living in this category, in this column, not more than this. If you have a $25,000, trust me, if you cannot make money by without however much money you have in the account, if you cannot make money on top of that, it doesn't matter how much money I give you, you will never ever make money in these trades or in this market. You have to trade small. When I say trade small, obviously you cannot do anything here. It costs you at least $300 or $250 to initiate a position in futures options. So you have to be somewhere around here. Now, when people ask me how much should I start trading with, I say at least 5K, because that's what I have. And then if you want to, you can go 10K. That's the second target you should have, 5K or 10K. Because what we do is, like, we do not invest more than 50 to 60%. $2,500 out of 5,000 will still be in dry powder, meaning we will still have money left. We need it for rolling purposes. We need it for adjustments. So that's why we don't use more than 50%. I would say 60 is a max. I wouldn't go more than 50 to 55%. So again, remember this one. This is how you should be trading. Anyway, okay, why do we sell these options, and what is the math behind it? I keep talking about math and probability. What is the math behind it? Now here's the math, right? If you take, let me take you a few slides down. If you take SPY's average daily returns from 2005 to 2025, and I put the code here. You can just go in any software that runs Python code, like I use PyCharm, just download it for free. Run this exact code, you'll know exactly what I'm talking about. Average daily returns has been 4 basis points, right? An average daily standard deviation has been 1.2%, 121 basis points. Now, if the current price, what does this mean? This means when the price is 520, let's say the price of SPY is $520 right now. It is expected to move up to 526 on a daily basis, up 6 months, and down, and then down 6 points, right? Sorry, up, yeah, same thing. Up 120 basis points, down 120 basis points. That's the average daily move of SPY for the last 20 years. You can go back 50 years from now and check this. It'll be almost the same. I checked it for this year because there's been a lot of volatility this year. These numbers were just slightly off, meaning this was a little bit more, um, and this was a little bit higher, meaning, if you take the average, this is how SPY moves. It moves 1.2% every single day, right? Now, why did I show you this? Because now let's get back to a actual SPY distribution for the last 24 years. I ran this for 24 years. Again, I have the code for this. If you need it, I will put it in the description in this document. You can download this. I'll put the link in the document in the description so you can download this. We think that actually, theoretically, the price of any underlying ticker based on its volatility should stick between 1, 2, and 3 standard deviation. That's the move from its mean. So let's say if the mean is in the middle here, this is the mean column, or this is the mean line. The expected move is 1, 2, and 3 standard deviation. Now, what do I mean by 1, 2, and 3 standard deviation? 1 standard deviation means 68% of the time, theoretically, the price is supposed to stay within 1 standard deviation from its mean. And this is the 1 standard deviation move I showed you, right? Now, actually and theoretically, the 2 standard deviation and 3 standard deviation moves are almost very similar. So you can just be comfortable. And I've run this in Python, and I ran this in Excel as well. I'll show you the Excel file too, like the way I did it. I just need to open that up, which I can right now. Okay, so it's opening up. So theoretically, we think that only 68% of the time the price stays within 1 standard deviation, but actually for the last 24 years, it was 81% of the time that it stayed within 1 standard deviation. So now if you sell options within this bracket, you are saying that the price will stay within 1 standard deviation and will not move further away from that. Then you have an 81% chance that you will be correct, because that's how many times, or that's the probability of the price staying within 1 standard deviation. And when we sell options based on 1 standard deviation. The expected move I showed you was based on 1 standard deviation. Okay, now you've seen the actual versus theoretical moves for the last 24 years for SPY. This is the main market ticker, the barometer of the US markets, right? Or the overall global markets as well. The 2 and the 3 standard deviation, we don't really touch. We don't get enough credit when we go out that far. So we stay within this range. This is our sweet spot. And if you look at this, if you have sold an option beyond the expected move for the last 25 years or 24 years, you would have won 81% of the time. That's what it shows. That's the actual move. Okay. Now, another thing I wanted to show you. Okay, look, this is how I got these numbers. So I took the closing price of SPY from Yahoo Finance. You can download this in a one-line code. Right? Download this, get the closing price of SPY. Then take the return numbers. This is the return formula, daily return, just division of two prices, right? From 2005 to like 2025. I think I need to change the heading there. But anyway, this is the last 20-year data, right? Go down, do this for the whole series, which I have done here, 414. And I actually included 2025 numbers too, 414, right? Then calculate the mean of it. How do you calculate the mean? It's just the average of the returns, right? That's the mean. Standard deviation, again, same thing. Use the standard deviation formula. I'm showing you a kindergarten math here that can teach you a lot of things about the markets, right? But this is a kindergarten level math. I've done some advanced level math from here, advanced level stuff, but this, just try to put it really, so that everyone understands basically. Anyway, so how did I calculate 1 standard deviation move? So you have to count the number of times this number, skewed away from your standard deviation number, and how many times. And you use this for like 2 and 3, and use this exact formula, and you get these numbers. So 81% of the time, the price stayed within 1. Fine. You get that, right? 2 and 3. Now, this shows me that this stayed 95%, 98%. Theoretically, very, very close. Okay? That's what the theoretical number is, 99 versus 98. Pretty good. Okay, so what are we looking at now? Okay, I've shown you this. Expected move. I've touched on this topic, expected move. How do we decide our range or our spreads or our, what do you call it, expected move? Now, there's a There's an easy way to do it in the on the platform. And if you go here on the chart section, edit the studies and bring in probability of expiring call. Put that in your price call, okay? And there you go. That's how simple it is. Now, what this shows us is if you look at this correctly, like, yeah, I think I should change this to setting on application setting. I think I need a light background here so I can show you the numbers. Okay, and then change this to font size. Let's do a medium. Usually I keep it small because that's how I like it. But anyway, let's do this here. Okay, so what is this showing? If you look at these red dotted lines, these are 30-day cycles. So look, like I showed you, these are the monthly cycles that are expiring. So current cycle is this one for something, then it's 516. Now, if you look at it's 516, then it's 620, and then it's 718. Now, these are almost every 30 days. So this is the expected move every 30 days. Now you can change that and then go further beyond and say, give me for every expiration cycle. That's fine too. But you can check that this is how, based on current volatility, this is how the underlying is expected to move in the next 30, 45 days. Now, if you're trying to sell a 45-day cycle, right, you're trying to sell it for 666, you can just hover over it and then see the numbers here on top in purple, right? Just look at those numbers. And you basically don't even need to do this because the platform actually tells you the expected move. So now if you go into this 52-day cycle, which is 20th of June, and go to 17 delta, this is where we would have sold it. Usually the platform's expected move is up to a 20 delta point, but our number is around 17. So that's why I want to show you the expected move, how to do it, how to calculate it. The chart below is the implied volatility, which is the main, very important one. We talked about implied volatility quite a bit. Now here's the bell curve of that standard deviation I was talking about. In the middle is the mean, fine. This is the average return, daily average return, right? And then 68% of the time, the expected move of this stock is 68.5% of the time, the expected move is within one standard deviation. 95% of the time is within two standard deviation, which is this. Now with three standard deviation is about 99% of the time. 99% of the time it has to stay within the three standard deviation mark. That's it. That's it. That's the bell curve. That's the normal distribution. Sometimes the price does not move in normal as a normal distribution, so which is fine. But for the most part, this is what you need to know, that it's a normal distribution, and this is how the standard deviations work. And that's why we sell here and here for both sides. Now, our strategy is to sell spreads, right? We sell spreads. This is a bull put, and we sell a bull call like this, right? We sell spreads, we make money on the spread side. And I'll show you exactly how we do it. Just trying to go through anything that, see if we've left everything. Anyway, go through the slide. There's some good info out there. Print it off, leave it out there. Again, like I said, this is the cheat sheet. We sell at 16% in the money. Same thing. Oh, this is another one. Okay, this is how you would read this slide. So go column by column. So don't go row by row. Go by column by column. And anyway, what am I trying to say here is long call as positive delta, which means when the price goes up, the underlying price goes up, option price goes up. It has positive gamma, meaning it changes with delta. So if delta is positive, gamma is positive. Long call has negative theta, meaning when every day passes, you lose this money. Long call, and let me cover long call and long put the same way. They're both the same. So volatility is positive, meaning when vol goes up, option price goes up in the long call and long put. Okay. Delta is negative for long put, meaning it gives you negative delta in the market. If you are short, if you want to take a short bearish view, you will take this to buy a long call. If you are a buyer of the option, we don't buy options. We would have sold a short call to take negative delta. This is another way of saying collecting negative delta in the market, right? Look at this. Either you sell a short call or you buy a long put. These are two ways of doing it. And row, we don't really look at interest rates because they have a very small effect on the option prices. But anyway, it's here, so like for you to look at. If rates go up, the option price goes up. So this is how you would look at this table. Print it off, put it in front of you until you remember this from in the back of your head. This is how I did it. I printed it off, put it on my computer as a sticky note, and until I knew exactly how the options were working, it was there. Short put again has positive, meaning the price goes down, the option price goes down. So it gives you positive delta. Look, this is the delta row. This number is positive, meaning it will give you positive delta. Okay. This is how you will look at this table. So take a look at this really quickly. I need to change this back to like a darker view because I don't really like it this way. Feel changes to small, changes to dark. Okay, now let's go through a complete setup of a credit spread in a futures options market. Right? Where will I sell a futures options? Where will I open trade right now? If I were to do a trade in ES, currently I cannot do a trade in ES because I already have two positions on. I already have an iron condor on. So if I were to do a position, I would have gone onto the same cycle, right? 52 days. First of all, I would look at the chart. Where is the chart showing? In the next 30 days, this thing is expected to move up. No, this is not futures option. Okay, so in the next 30 days, this is showing me in the next 50 days or somewhere here, okay? 620 with the expiration date, right? There. Just it can be low. It can be around 5100 to 6100. Wow, that's a big expected move. Now, what does volatility does? It expands the expected move. Meaning, before the volatility was low, your expected move was just between these points. Your one standard deviation was move was this much. When the volatility pumps up or it goes up, it expands the expected move. Meaning now you can sell further strikes and create a bigger chart around a bigger color around your price. That's what volatility does. It expands the expected moves, and it's good for the market, good for the sellers because now you're getting juicier premiums and you can be further away from the strike. Okay, that's what it means. So in the next 30 days, if I have to take this cycle, right, 5100, 6100, let's keep that in mind. You would have sold a put option spread short put. So I would have sold it at this level. Look, I'm nicely sitting on the 5100 strike. I don't need to do anything. But if I were to do something, I would sell a short put option, right click, 17 delta, right? Reduce this to one contract and 25 points out, totally fine. You're collecting $4. Four is a good number, meaning you're collecting $200 for this. Now, when you analyze this number, when you analyze this chart, this trade, you would see a 80% pop. 80% pop. Let me take anything else out. Just put the short put spread on. Look, okay, so if you go here, break even, set slices. Break even, and then 621. That's when it expires, right? Look at this number, 82. That's what I like. I like the number 8 before anything else. So that's what I like, 82%. Now, what this means is like you have an 82% chance that the underlying will stay within the grade area. And the grade area is where you have covered yourself. Your break even is just beyond that grade area. So, and your max loss here is 1050, which is totally fine, not a problem. We don't ever go to max loss on these trades. we have to manage these. So now this is not showing the right buying power reduction because I already have a position on, so it will take less money out of my account. But if you were to put this position on, it would have been $350 to 400, or maybe even less, right? So you can calculate the ROI. Even if you collect 50% of the profit here, meaning 100, and you put down 350 or 400, that's 25% done, right? Take out the commissions, and if you have to annualize this trade, meaning you do it for 5 or 6 times a year, you can just annualize this number and see how it goes, how the account can actually return good, consistent income if you keep doing the same things here. Anyway, this is all I have to show you guys. Like, why do we do what we do? I will put these in the description. You can download all of this, go through it again one more time, and then I'll see you in the next video. And if you like it, if you like my content, just hit follow, subscribe. Thank you very much. Bye-bye.